Hello, thanks for joining me today. My name is Briant Sikorski, and I'm an independent wealth advisor with Stratos Wealth Partners. As a wealth advisor, I help clients work toward achieving their financial goals by providing planning, which includes financial, insurance, retirement income and education savings, asset and income protection, including life, disability, and long-term care insurance, investment management, including brokerage and advisory investment management accounts consisting of stocks, bonds, mutual funds, and exchange-traded funds, and tax-deferred retirement income strategies, including IRAs, Roth IRAs, 401ks, SEP, simples, and also annuities, including fixed indexed, and variable annuity products. Today we will be talking about the Tax Cuts and Jobs Act. So we can see that in the final weeks of 2017, Congress passed the most comprehensive tax reform package in decades, reducing tax rates for individuals and corporations and making modifications to many tax rules, including deductions. This bill represented the largest change to the tax code since President Reagan's Tax Reform Act of 1986. President Trump signed the Tax Cuts and Jobs Act into law on December 22, 2017. The broad changes mean that the law will impact individuals, estates, trusts, corporations, and small businesses. While lawmakers initially sought to simplify the tax code, the final package was mixed. Some provisions have been eliminated or simplified, while several new tax rules were added. During our discussion today, we will examine the key portions of the new law and highlight some potential income and estate planning strategies you may want to consider when working with your financial professional. So here's our topics for discussion today. First, we'll start by just reviewing the key provisions. Then we'll highlight specific actionable planning ideas to consider in collaboration with your financial advisor. Let's start out with a few highlights. Marginal tax rates for both individuals and businesses decrease under the new law. In fact, the tax rate on corporations is lowered from 35% to 21%. There are also new rules for pass-through businesses, a 20% deduction for qualified business income. While tax rates are lowered, many popular tax write-offs are scaled back or eliminated entirely. Some wealthier individuals and families will benefit from a higher estate and gift tax exemption, which will reduce the number of estates paying estate tax. In a move to raise revenue, the individual mandate of the Affordable Care Act was repealed. And lastly, because of strict budget rules related to the budget reconciliation process in the Senate, the individual tax provisions sunset in 2025. So here's a look at the new tax brackets. As you notice, there are still 7 brackets as in the past, but tax rates applied are generally lower. The maximum rate is now 37%, down from 39.6% previously, not including the 3.8% surtax on net investment income, which applies to single filers with taxable income in excess of $200,000 and joint filers with income in excess of $250,000. So let's compare how the new tax brackets differ from the old ones. In this chart, we're looking at specific levels of income based on the brackets to get a sense of how the tax rates differ. For example, while there is no change in the 10% tax rate applied to the first $9,525 of income, the tax rates differ on the next amount of income between $9,525 and $38,700. The old system taxed this level of income at 15%, while the new tax law taxes this level of income at 12%. You will notice that at some levels of income, the tax rate for the new law is actually higher, and these are displayed in red. However, even taxpayers with income at these levels will benefit, since this is a marginal tax rate system. That is, tax rates are assessed against income marginally. For example, even though all individual with $250,000 in taxable income may find themselves in a 35% tax bracket with the new law, he or she will still benefit from lower marginal tax rates at the lower income levels. A taxpayer in the 35% tax bracket only is taxed 35% on the amount of income exceeded the income threshold for that bracket. Under the new law, income begins to be taxed at 35% only on the amounts above $200,000. Similar to the previous chart, here's how tax rates compare for couples filing a joint tax return. In general, tax rates on long-term capital gains and qualified dividends do not change as a result of the new law. However, they are based on the previous brackets where the long-term capital gain qualified dividend rate was as follows. 10% and 15% brackets equals 0% capital gain and qualified dividend rate. 25, 28, 33, and 35% brackets equal 15% capital gain and qualified tax rate. 39.6 brackets have a 20% capital gain and qualified dividend tax rate. Because the brackets and corresponding tax rates have been modified, the capital gain to qualified dividend rates do not align with the income tax rates anymore. They are based on certain income levels as shown in the chart above. One area of significant change in the tax code is deductions. Here is a summary of the major tax deductions and resulting changes, if any, due to the new tax law. With the standard deduction nearly doubled, most taxpayers will claim the standard deduction and less will itemize deductions on their return. Today, roughly a third of all taxpayers itemize. Going forward, some tax experts predict that less than 10% of all individuals will itemize. Here is a few of the other notes on key deductions. Mortgage interest is now capped at $750,000 in debt, down from $1 million before the tax law. For example, if you have a $900,000 mortgage, you can write off interest based on $750,000 of that debt, but not the total amount. This debt can include a second mortgage, but the total debt cannot exceed $750,000 for the interest deduction. Taxpayers are no longer able to write off interest on home equity lines of credit unless the proceeds are specifically used for home improvement. These rules are complicated, so clients should consult a tax professional. State and local taxes have taxpayers limited to a total deduction of $10,000 from local property taxes, as well as state and local and sales taxes. For example, if you have $12,000 in property taxes and $15,000 in state income taxes, you can only deduct a total of $10,000 on your return. Other deductions that were repealed include casualty losses, unless a federal disaster is declared. Alimony payments are no longer deductible, and alimony received is no longer considered taxable income. Moving expenses, except for members of the armed forces, are no longer deductible. Lastly, examples of miscellaneous deductions which are now eliminated include unreimbursed job expenses, certain membership dues, investment fees, and tax preparation expenses. While personal exemptions were repealed in the new law, the child tax credit is expanded both by increasing the amount and by making it available to more taxpayers by raising the income phase-out significantly. The alternative minimum tax remains, but will apply to fewer taxpayers. The exemption is increased to $70,300 for individuals, up from $55,400, and $109,400 for married filing jointly, up from $86,200. According to the Tax Policy Center, only 200,000 taxpayers will be subject to the alternative minimum tax going forward, down from roughly 5 million individuals previously. So here's a simple case study to highlight how taxes may change for some. In this example, we assume a family of 4 with an adjusted gross income of $200,000. We assume they are claiming the standard deduction. Let's compare how their taxes will differ. You'll notice under the old system, the standard deduction is significantly lower, but they are able to claim 4 personal exemptions for each member of the family, totaling $16,000. The personal exemption is not available under the new tax law, but the standard deduction is higher at $24,000. Taxable income is actually higher under the new law, but the actual burden is lower, which is reflective of the lower tax rate schedule. Lastly, under the new law, the family is able to claim a $2,000 tax credit for every child under the age of 17. Under the previous tax system, the child tax credit was phased out for high-income taxpayers. The phase-out began at $110,000, and for couples, while the phase-out is $400,000 now for couples. Here are some other areas of note with respect to the new tax law. Some additional details on a few include, beginning in 2018, annual inflation adjustments will be based on a formula that generally results in a lower inflation figure. The option to recharacterize or undo or have a do-over with regards to a Roth IRA conversion has been eliminated. Investors still have a choice of several options for calculating cost basis of shares. They're not limited to just the first in, first out when it relates to stock sales. While deductions are now limited, there is no phase out of deductions at higher income levels. 529 accounts or college savings plans have a provision to allow funds to be used for homeschool expenses was removed from the bill at the last minute, but 529 plans are still expanded for kindergarten to 12th grade expenses. This limitation of $10,000 applies on a per student basis rather than a per account basis. Thus, under the provision, although an individual may be designated beneficiary of multiple accounts, that individual may receive a maximum of $10,000 in distributions free of tax. With the Tax Cuts and Jobs Act, less estates will be subject to estate tax. This is because the lifetime estate gift exemption amount doubles to over $11 million per individual. That means that a married couple can effectively shelter over $22 million in net worth from estate taxes. Of course, these rules sunset after 2025, when the exemption amount will revert back to current levels adjusted for inflation. Also, the annual gift exemption increases by $1,000 to a total of $15,000 in 2018. While many estates will fall below the exemption level, this doesn't mean that only individuals and families with significant wealth need to focus on estate planning. The reality is that proper estate planning extends well beyond minimizing or preparing for federal estate taxes. It's critical to have the right documents in place to address address the risk of an unforeseen circumstance, such as incapacitation, as well as plan for the orderly and efficient transition of property at death. A key area of this comprehensive tax law is the overhaul of business-related taxes. Prior to the law, the 35% corporate tax rate was the highest in the world. Reducing it to 21% brings it in line with developed nations. However, most businesses in the U.S. are not large corporations, but are structured as pass-through entities, such as S-corps, LLCs, partnerships, and sole proprietorships. While the top marginal tax rate of 37% applies, many of these businesses will benefit from a 20% deduction of their business income. Another attractive benefit for corporations is 100% expensing over the next 5 years, which will provide an incentive for companies to expand and purchase equipment. On the negative side, companies who employ leverage to raise capital may see their borrowing costs rise as they are limited in deducting those net interest payments. For 4 years, the 30% limitation is based in earnings before interest, taxes, depreciation, and amortization, also known as EBITDA. After that, the deduction is limited to 30% of earnings before interest and taxes, EBIT. Lastly, due to tax reasons, many large corporations hold significant amounts of profit overseas. As part of the law, these overseas profits may be considered repatriated whether or not the company brings the assets back to the U.S. So here are some planning considerations and strategies that might be useful to you. Number 1, invest in municipal bonds to generate tax-free income. Even with slightly lower tax rate, municipal bonds may be attractive for taxpayers in higher tax bracket who are also subject to the 3.8% Medicare tax. 2, utilize strategies to reduce or avoid taxable income, such as retirement plan contributions like 401ks, IRAs, SEP IRAs, flexible spending accounts, health savings accounts, and deferred comp plans. 529 college plans are now expanded for K through 12 tuition expenses, which they could not be used for previously. Be mindful of transactions that may drastically increase your income, and retirees may consider donating IRA assets directly tax-free to charities. It's very difficult to predict the future of tax rates and policy. Holding a portion of retirement savings inside of a Roth IRA can act as a hedge against the direction of future tax rates or a taxpayer's own tax circumstance. Roth IRA conversions need to be closely analyzed since the recharacterization provision, which allows investors to reverse a conversion, is no longer available. Number 4, maximize deductions in years when itemizing. Taxpayers, especially those who are committed to regular charitable donations, may see the appeal of lumping deductions into one year and itemizing deductions on the tax return for that particular year. For example, instead of making consistent charitable gifts each year, consider making a large gift in one year or funding a donor-advised fund if that allows you to itemize deductions on your tax return. In other years, just claim the standard expanded deduction. 5. It may make sense to time the withdrawal of funds from tax-deferred accounts for years when you're likely to be in a lower marginal tax bracket compared with your pre-retirement tax bracket. These years could normally occur early in the retirement before required minimum distributions from retirement accounts begin, normally at age 70.5, or later in retirement when medical expenses may be higher. Conversely, once your bracket increases, it may be effective to draw income from taxable or tax-free accounts. The doubling of the lifetime exclusion changes the landscape for many in terms of planning for estates and gifts. However, many states still have their own death taxes in place. For example, estates over $1 million in value in Massachusetts, big surprise, are subject to estate tax. Residents in those states need to consider options such as life insurance, which may provide liquidity at death for their survivors to pay the tax bill. Since full step-up in cost basis at death is still available, many families will want to assess which property has a low basis and try to maximize a step-up at death. For example, gifting assets while living will result in a carryover basis to the person who receives the gift. Additionally, certain trusts may be decanted or poured over to new trusts, which may account for step-up in cost basis. For those in high-income states, California, for example, creating trusts in other tax-friendly states may be means of mitigating state taxes, such as Nevada or Delaware trusts, for example. For those who have funded trust, such as a bypass for X at benefit from step-up in cost basis at death, this depends on whether there is an appropriate amount of estate gift tax exemption in place. Lastly, it's critical to work with a qualified financial planner, estate planning attorney, and CPA, since these new laws can be very complicated and, more importantly, are always changing. Most businesses in the U.S. are not large corporations, but are structured as what is known as pass-through entities. These are known as S corporations, limited liability corporations, partnerships, and sole proprietorships. While the marginal tax rate for individuals and couples apply, with a maximum of 37%, many of those businesses will benefit from the new 20% deduction on their business income. The new law establishes a 20% deduction of qualified business income from certain pass-through businesses. Specific service industries such as health, law, and professional services may be limited to claiming this deduction depending upon their income. A late change in the legislation removed engineering and architecture professions from being considered specified service businesses. Here's more detail on the new 20% deduction for pass-through business income and how it works. Small business owners should work with a tax expert to make the most of the new 20% deduction. It's a new addition to the tax code, so business owners should take steps to understand how it works and how timing of income and other actions may impact the deduction, both positively and negatively. Significant changes may be on the horizon in the future as our nation grapples with federal debt and the pressures of the entitlement program. Investors would be well served to keep a close eye on how these changes will impact their personal finances. The best preparation is to consult with a financial advisor or tax professional who can offer some perspective on your specific financial and tax situation, help you understand the risks, and position your assets accordingly. The markets and the regulatory environments are always changing, and in uncertain times like these, sound financial advice should be the foundation of any long-term investment strategy. So again, thank you very much for joining me today. I hope you maybe learned a couple new facts. This webinar is on my YouTube channel, and you can access it by going to my website at www.briantsikorski.com. That's BRIANTSIKORSKI. And click on the YouTube icon in the upper right-hand corner of my website. It'll take you to my YouTube channel where you can watch this and other related videos. Also be sure to click on the subscribe button in YouTube, and that way when I have new videos uploaded to YouTube, you'll be notified and given the opportunity to watch them. So with that, I will say thank you very much and have a great rest of your day.